At the height of the Great Depression, American states reached for a tax that had barely existed anywhere in the country before. It appeared on ordinary purchases. It followed citizens into grocery stores, clothing shops, and hardware counters. Within a few years, it became one of the central pillars of state finance. The sales tax now feels permanent. Yet for roughly the first century and a half of the Republic, state governments survived without it. They built courthouses, maintained roads, supported schools, raised militias, operated prisons, and financed an expanding public order through a far older and less uniform system. That system depended on land, licenses, lotteries, tolls, public borrowing, and taxes whose burdens were often distributed according to political power rather than economic logic. The story begins in 1789 with a federal government that possessed constitutional authority but almost no money. The Revolutionary War had left the United States burdened by approximately $79 million in public debt. Foreign governments expected repayment. Domestic creditors held securities of uncertain value. Veterans had received promises that the new nation struggled to honor. Under the Articles of Confederation, Congress had been unable to impose direct taxes. It could request funds from the states, but the states were free to delay, reduce, or ignore those requests. Independence had been won, but the central government remained financially dependent on persuasion. Alexander Hamilton regarded that weakness as a threat to the Republic itself. As the first Secretary of the Treasury, Hamilton argued that sovereignty required reliable revenue. A government unable to collect money could not service its debts, defend its territory, or command the confidence of lenders. His first great instrument was the tariff. The Tariff Act of 1789 placed duties on imported goods entering American ports. Customs officers inspected cargoes, assessed the charges, and transferred the revenue to the Treasury. For a young and largely coastal nation, the system offered an administrative advantage. The government did not need thousands of collectors traveling through farms and villages. It could concentrate enforcement at a limited number of harbors where international trade entered the country. Tariffs also served Hamilton's larger economic program. By making imported products more expensive, duties protected American manufacturers from established European competitors. Government revenue and industrial policy became part of the same mechanism. Hamilton developed that argument in his 17091 report on manufactures. The United States, he believed, could not remain dependent on foreign workshops. Protective duties would give domestic industries time to develop until they could compete on their own. For much of the 19th century, tariffs became the financial foundation of the federal government. Customs duties regularly supplied between half and nearly all federal revenue. Even in 1900, when the economy had become one of the world's largest, Washington still derived a major share of its income from imported goods. That arrangement was possible because the federal government itself remained small. Its principal expenses included national defense, debt payments, customs administration, the postal system, and eventually Civil War pensions. There was no permanent federal income tax and no vast network of national social programs. But Hamilton understood the danger of depending entirely on trade. Shipping could be disrupted. Imports could decline. War could close ports. In 1791, he persuaded Congress to impose an excise tax on distilled spirits. The whiskey tax was narrow rather than general. It targeted one product instead of taxing retail purchases as a whole. Yet on the western frontier, the burden reached far beyond drinking. Farmers in western Pennsylvania and other inland regions often converted grain into whiskey because distilled spirits were easier to transport and more valuable than raw corn or rye. Whiskey also circulated as a medium of exchange in communities where currency was scarce. The excise therefore struck at the economic structure of frontier life. Small producers believed the system favored large commercial distillers who could pay lower effective rates. Resistance escalated from evasion to intimidation. Tax collectors were threatened, assaulted, tarred, and feathered. By 1794, the conflict had become the Whiskey Rebellion. President George Washington called out a militia force of roughly 13,000 men and moved west to demonstrate that federal law would be enforced. The rebellion dissolved without a major battle, but the precedent was unmistakable. The government created by a revolution against imperial taxation was now prepared to use military power to collect its own taxes. While Washington relied on tariffs and selective excises, the states built a different financial order. For most state and local governments, the central instrument was the property tax. The practice predated independence. Colonial governments had taxed land, buildings, livestock, and other tangible assets, and the states continued those systems after the Revolution. Property appeared to offer a visible measure of economic capacity. Land could not be moved offshore or concealed in an account book. Local officials could inspect a farm, a house, or a shop and assign it a value. In practice, the system was vulnerable to manipulation. Professional appraisal barely existed. Records were inconsistent. Local assessors often relied on personal judgment, political relationships, and incomplete information. Two similar properties could receive dramatically different valuations. Favoritism was common. A landowner connected to the assessor or local government might receive a convenient reduction. A political opponent might not. The property tax also became less equitable as the economy changed. Small farmers and homeowners held much of their wealth in visible land and buildings. Merchants, bankers, and industrialists increasingly held wealth in securities, debts, business partnerships, and other financial claims that were difficult to locate and assess. The tax was supposed to reach wealth. It often reached the forms of wealth least able to hide. It also tied public revenue to unstable property values. In prosperous years, assessments increased and collections rose. During contractions, land prices fell, owners became delinquent, and governments lost revenue precisely when communities needed assistance. Yet for generations, the property tax remained indispensable. By the early 20th century, it still supplied an enormous share of state income and dominated local finance almost completely. There was, however, a period when several states believed they had discovered a better way. During the early 19th century, states began acting not merely as governments, but as investors and entrepreneurs. The most successful example was New York's Erie Canal. Authorized in 1817, the canal stretched approximately 363 miles between Albany and Buffalo, connecting the Hudson River to the Great Lakes. Its locks carried boats across a substantial change in elevation, opening a water route between the interior and the Atlantic coast. New York financed construction largely through bonds. Investors supplied capital in exchange for repayment funded by future tolls. The project was a gamble on geography, commerce, and migration. It succeeded beyond expectations. Tolls covered debt service soon after the canal opened. Trade between western farms and eastern ports expanded dramatically. Transportation costs fell. Settlements grew along the route. New York City emerged as the country's dominant commercial port. By 1834, canal revenue had erased the original construction debt. The result appeared to offer a new model of public finance. A state could borrow money, build infrastructure, charge users, repay investors, and earn continuing revenue without relying heavily on taxes. Other states rushed to reproduce the achievement. Pennsylvania, Maryland, Ohio, Indiana, Illinois, and others issued debt for canals, railroads, roads, and related improvements. European investors, particularly in Britain, purchased American state bonds attracted by their comparatively high returns. By the late 1830s, state borrowing had grown on a scale that dwarfed local and federal debt. But most states did not possess New York's advantages. Their routes crossed more difficult terrain, connected smaller markets, or competed with emerging transportation alternatives. Construction costs exceeded projections. Toll revenues disappointed. Some projects remained unfinished. The financing structure depended on continued growth and confidence. When the Panic of 1839 pushed the economy into depression, the weakness was exposed. Revenues fell while interest payments remained fixed. By 1842, 8 states and the territory of Florida had defaulted on portions of their debts. Pennsylvania and Maryland were among the governments burdened by enormous transportation obligations. European creditors who had treated American state bonds as promising investments suddenly held securities that could not be paid as expected. The defaults damaged American credit abroad and transformed domestic attitudes toward public borrowing. Several states rewrote their constitutions to restrict debt, require public approval for borrowing, or prohibit direct investment in private enterprises. The age of states financing ambitious infrastructure projects in the hope of earning their way out of taxation began to close. The Erie Canal had demonstrated that government enterprise could transform a continent. Its imitators demonstrated something equally important. Public profit could not be assumed, and when the gamble failed, the losses returned to taxpayers. States still needed revenue. Property remained taxable, but politically vulnerable. Borrowing had become dangerous. Tariffs belonged to the federal government. The search now turned toward a collection of less visible sources: head taxes, business licenses, lotteries, and land sales, each carrying its own hidden cost. With large-scale borrowing discredited, state governments returned to a more fragmented collection of revenue tools. One of the oldest was the poll tax, sometimes called a head tax or capitation tax. Unlike a property tax, it did not attempt to measure wealth. It imposed a fixed charge on each eligible adult. The method had deep colonial roots. Virginia and Maryland relied heavily on poll taxes before independence, and many states continued using them throughout the 19th century. By the early 1920s, dozens of states still authorized or required some form of head tax, often directing the proceeds toward schools, roads, or local government. Administratively, the tax was simple. Politically, it was dangerous. Because every taxpayer owed the same amount, the burden fell most heavily on people with the least income. A charge that was trivial to a wealthy merchant could be significant to a farm laborer or industrial worker. In the post-Civil War South, the tax acquired a more deliberate purpose. Several states made payment a condition for voting. Combined with literacy tests, intimidation, and discriminatory registration systems, the poll tax became part of the machinery used to disenfranchise black citizens and many poor white citizens. A revenue instrument had been converted into a political barrier. The use of poll taxes in federal elections was eventually prohibited by the 24th Amendment in 1964, while later court decisions in the Voting Rights Act helped dismantle their remaining role in elections. States also collected money through licenses. Merchants, tavern keepers, physicians, attorneys, auctioneers, and other businesses or professions could be required to pay for permission to operate. Pennsylvania introduced a mercantile license tax in the early 19th century, one of several systems sometimes described as precursors to the modern sales tax. But these were generally taxes on the privilege of doing business, not on each individual transaction. A merchant might pay according to the type or scale of the enterprise, while customers saw no separate percentage added to every purchase. The revenue could be useful, especially in commercially active states, but it rarely matched the importance of the property tax. Lotteries offered another solution, one that allowed governments to raise money without openly compelling anyone to pay. Public lotteries were central to colonial and early American finance. The Continental Congress authorized a lottery during the Revolution, hoping to raise funds for the war. States later used lottery proceeds for roads, courthouses, hospitals, schools, churches, and charitable institutions. Some of the country's best-known colleges benefited from lotteries, including Harvard, Yale, and the College of New Jersey, later renamed Princeton. When Boston's Faneuil Hall required reconstruction after a fire, lottery proceeds helped finance the work. The political advantage was obvious. Buying a ticket was voluntary. Participants paid for the possibility of a prize, while government retained part of the proceeds for public projects. In effect, the lottery transformed hope into revenue. Its weakness was corruption. Drawings could be manipulated. Agents could steal ticket money. Promoters could sell tickets for projects that were never completed. Congress itself approved lotteries intended to support improvements in Washington, D.C., only to see private operators involved in the process disappear with funds. By the middle of the 19th century, scandals had severely damaged public trust. Reform movements increasingly condemned lotteries as fraudulent, immoral, or both. By the late 1800s, most states had prohibited them. The lottery would return in the 20th century, but for several generations it ceased to be a dependable fiscal instrument. Public land provided another source of income. The federal government controlled enormous territories acquired through war, treaties, purchases, and the displacement of native peoples. Under measures such as the Land Ordinance of 1785, parcels could be surveyed and sold to settlers, speculators, and development companies. Land sales raised revenue, but they also served strategic goals. Lower prices encouraged migration and settlement. Higher prices brought more money into government accounts. Policymakers repeatedly struggled to balance those objectives. States also sold or leased land they controlled, sometimes using the proceeds to support schools or reduce the need for direct taxation. Together, these methods formed the financial architecture of 19th century America. The federal government relied chiefly on tariffs, supplemented by excise taxes and land sales. States assembled different combinations of property taxes, poll taxes, licenses, lotteries, tolls, and borrowing. Local governments remained overwhelmingly dependent on land and buildings. There was no unified national system. Revenue policy reflected geography, political culture, economic structure, and the influence of different groups within each state. That patchwork survived because government responsibilities were limited and economic growth repeatedly concealed its weaknesses. Two events finally destroyed the old arrangement. The first was the 16th Amendment. Ratified in 1913, it confirmed Congress's power to tax income without apportioning the burden among the states according to population. The federal income tax gave Washington a source of revenue that could grow with wages, profits, and the broader economy. Tariffs no longer had to carry the federal government. States experimented with income taxes of their own, but the administrative challenge was considerable. Income could be concealed more easily than land. Effective collection required records, auditors, reporting systems, and a bureaucracy capable of identifying non-compliance. Some states built those systems, others lacked either the political support or the administrative capacity. The second event was far more destructive. After the stock market crash of 1929, the American economy entered the Great Depression. Property values collapsed, unemployment surged, wages fell, and businesses failed. State and local finance deteriorated with the economy. Property owners who had lost jobs or farm income could not pay their tax bills. By 1933, more than a quarter of property taxes nationwide were reportedly delinquent. Local governments, which depended heavily on those payments, faced a financial emergency. The timing could not have been worse. Demand for relief, policing, public health, and basic services increased just as revenue disappeared. Governments needed more money, while citizens had less ability to provide it. Attempts to preserve collections produced a political revolt. Homeowners and farmers organized associations demanding lower assessments and reduced rates. Some withheld payments. Others pressured officials directly. Property taxation, once treated as the natural foundation of local government, came to symbolize a system capable of taking a family's land during the worst economic crisis of their lives. Under pressure, states adopted exemptions, reduced assessments, and limited tax rates. Property tax revenue declined sharply as a share of state income. Governments needed a replacement that was broad, relatively simple to administer, and politically easier to defend than further taxes on homes and farms. The retail sales tax offered all three. Mississippi moved first, adapting an existing grocery soup system into a general tax on sales around 1930, with later legislation formalizing the structure. West Virginia adopted a broad retail sales tax in 1933 after previously taxing selected commodities. Other states followed rapidly. During the 1930s, more than 20 states enacted general sales taxes. The policy spread not because economists had suddenly discovered an ideal form of taxation, but because fiscal collapse had narrowed the available choices. A sales tax captured revenue whenever money changed hands. It did not require officials to estimate the value of every farm or reconstruct each taxpayer's annual income. Retailers collected the tax from customers and transferred it to the government. The burden was also dispersed across millions of transactions. No single assessment arrived with the same visibility as a large property tax bill. That political advantage concealed the tax distributional effect. Sales taxes are generally regressive because lower-income households spend a larger share of their earnings on consumption. A wealthy family and a poor family may pay the same rate on a taxable product, but the payment consumes a far greater proportion of the poorer household's resources. The design therefore shifted part of the public burden away from property ownership and toward everyday consumption. Large landowners gained relief from a system that had concentrated taxation on visible assets. Wealthier households could save or invest more of their income, placing it beyond the immediate reach of a retail tax. Working families, by contrast, spent much of what they earned and encountered the tax repeatedly. The sales tax was presented as fiscal necessity, but it was also a choice about who would finance government. The end of Prohibition strengthened the new structure. After alcohol became legal again in 1933, states imposed excise taxes and reorganized licensing systems to capture revenue from its sale. Income taxes, corporate taxes, alcohol levies, and general sales taxes expanded alongside one another. Within a single decade, the American tax system was transformed. The federal government increasingly relied on income taxation. States combined income and sales taxes in different proportions. Local governments continued to depend on property taxes, though with new limits and exemptions. The arrangement that now appears permanent was largely a response to crisis. For most of American history, no clerk added a general state tax to the price of an ordinary purchase. Governments had relied on ports, land, licenses, lotteries, toll roads, head taxes, and public debt instead. Those earlier methods were not necessarily fairer. Tariffs raised consumer prices, poll taxes punished the poor and helped suppress voting. Lotteries extracted money through chance. Property taxes were corrupted by unequal assessments. Infrastructure schemes enriched insiders when they succeeded and left taxpayers with debts when they failed. The central issue was never merely how governments collected revenue. It was which groups possessed enough power to redirect the burden. Every tax system embodies a political settlement. Tariffs protected manufacturers. Property taxes targeted the most visible form of wealth. Poll taxes combined revenue collection with social control. Sales taxes offered relief to property owners while reaching nearly everyone through consumption. The modern sales tax was not inevitable. It emerged when the Depression destroyed the system that preceded it and left states searching for money they could collect without provoking an even greater revolt. Its survival reflects the same quality that made it attractive in the 1930s. It is encountered in small increments, distributed across countless purchases, and rarely experienced as one dramatic demand. The tax appears quietly at the bottom of a receipt. Behind that small line lies 2 centuries of debt crises, political bargains, failed canals, public resistance, and arguments over a question that no government has ever permanently resolved. Who should pay for the state, and how much power should they have in deciding the answer?